This video is going to go over how to use the hourly moving average to find trades. Most Forex traders are longer term traders, and so an hourly chart to many of the largest Forex traders out there is actually their fastest chart. I found that the 20 period simple moving average is a very good filter. Above that you want to buy, and below that you want to sell. You can see the euro dollar here, for instance, last night broke from above to below the hourly, came back up and did a retest, and then trended down. And typically when a currency makes a move, whether it's up or down, and then returns to the hourly, the first and oftentimes second time it touches the hourly is the end of the move, and it's a pretty decent place to look for continuation of the trend, which in this case is down. You can see that happened today in the euro. It rallied back up to it, found resistance, and then came down. It also made a two-wave move up to it where it went up here, pulled back a little bit, then went up to the 1.382 fib target. This is called our Elliott two-wave fib system. When you see a price like this get hit, along with any other system showing up at the same time, this is an Elliott two-wave fib system sell, and it's a return to the hourly moving average resistance area sell as well. And you can see it pulled back immediately about 25 pips and then continued down. You can also use our range charts to use this as well. This is on our containment bands, and you can see it came up to that level. You can wait for the trailing stop to get hit and go short again when it gets hit again, and you can see that the second trade went about 50 pips. Let's look at some of the other currencies. Here's the hourly moving average on the pound dollar, which also is right at where our Fibonacci retracement level is. Let me bring up the range chart where I don't have our trading zones and fib areas on. Anytime price comes up to the hourly from underneath it, you can look to sell. If you get short and the market goes sideways like this and breaks above it, you want to get out of your trade and flip and go long. And most of the time it's going to go to where the fib target is. So if you lose 5 or 6 or even 7 or 8 pips on a trade shorting here, and first of all notice that it went up to the hourly moving average with pretty decent statistical strength. If you get into a trade, you put your stop above the high right here, and it goes down a little bit. You move your stop to break even. You could have got out of this trade with 4 or 5 pip loss, flipped and gone long here at 16, and your first profit target's 35. So it's about 20 pips away. Even if you lost 10 pips on the first trade, and it goes to the first fib target on the second one, on your second trade, you're going to get back your loss plus an extra 10 pips. And you can see it went right to the 1.618. This usually, probably about 70% of the time, is the maximum distance the price moves, and it will then either go sideways, pull back and continue up, or go sideways and then crash. This one pulled back and had a 1, 2, 3 high, then reversed. But the hourly is a great place to look for trades. I prefer, if this came back down and found support here and went sideways, when it would start going back up, you'd want to buy. And sometimes those trades fail, as you can see this one did right here. But when they break from above to below the hourly, usually that's a nice start of a new downtrend. Here's the euro yen. This one broke from above to below the hourly, and you might have even went short right here. Notice the trailing stop came down. You probably would have had a small win, small loss. When it breaks above the hourly, if you went long right here, it went up about 15 pips. We have a counter trend signal. But even so, look where the trailing stop is. The trailing stop gets yanked up. You have a small loss. Typically when currencies are kind of chopping around like that, you really want to wait for a breakout one way or another. And typically it happens within an hour or two. This one has a nice, you can see there's high volatility. It gets lower and lower and lower. And anytime you have multiple false breakouts above and below the hourly and volatility decreases like this, usually when it breaks out of the trend line, whether the upper one you buy, the lower one here you clearly sold, you can see it fell from 90 all the way down to 20. It was much more likely to go down, even though the daily, weekly, and monthly trend was up. This one had a major counter trend signal right here. These big yellow dots, usually the end of the move. Sometimes 3 to 5 hours later, price will reverse. Sometimes it takes up to 12 hours. But the vast majority of the time you see one of these big counter trend sell signals on a current, it basically means the currency's been up for 1.5 to 3 days, violently up, statistically too far up. It's a very high probability reversal. Here's the pound yen, and anytime you see a currency kind of going sideways right underneath or above the hourly, or slightly above and below it. Sometimes it breaks 5 to 10, 15 pips above, comes back down. It's in a very tight rectangle pattern. When these things break out, they're usually pretty high probability. You notice how our intelligent trailing stock got out here at 07, or yeah, at 7. It caught all of the move except for 9 pips. That's pretty good trailing stop. You're not going to find much better than that. And here's a good example of when it came back and hit the hourly. Usually I like to see it hit the hourly and go sideways for a couple 5-minute bars or a couple of range bars. And when it breaks above, the last 1 or 2 bars high, you would go long. But in this case, it didn't. Found support at the hourly. There was buying here to stop it from going down, but there was no aggressive buying coming back in. And you can notice on our statistical trend tools that this stayed red the whole time, which means the pound is weaker than the majority of other currencies and the yen's strong. So you always watch our statistical trend tools. Most of the time price goes in this direction. So when it breaks down underneath the low here, you go short because it did spend enough time there showing you that there were some buyers. All the buyers that got sucked in when it started going lower, they were losing money and they have to rush out and sell to exit their trade at a small loss. And you have your fib targets down here. Most of the time I'm going to get out of my trade at the 1.618. In this case, if you let the trailing stop get hit, you gave back a few measly pips. Or if you held on. Anytime it goes beyond the 1.618, if you see the statistical strength kind of subsiding, you want to get out of the trade, especially at a monthly pivot level right here, the lower containment band, and so forth. Here's a currency that's kind of been going sideways for hours. So if you had sold the low, which you were right to do, the weekly trend's down, the monthly trend's down. Notice the trailing stop, had you out of this with a small loss. And usually false breakouts that go back above it, continue to trend. So if you wanted to exit your 5 or 6 pip loss and flip and go long, it went from about 18 here all the way up to 35. Or if you got out here at your trailing stop, you never know. The trend's not really confirmed to be explosively up until it breaks this high right here. This was the previous swing high, and it wasn't able to do it. So if you get into one of these trades with a small profit, typically you're better off kind of waiting to see what happens. You can see it came back down, found support at the hourly, couldn't go underneath it, and it did go sideways long enough that I personally would buy it here expecting it to go above the high. Anytime you see a double top or double bottom, that's typically the end of the trend. But the third time you buy or sell at a double top or double bottom area, you typically will lose money. The good news is if you anticipate the third time a price level gets hit, it's going to bust through like it did here. If you bought right here, you can get in a little bit early anticipating it breaking through this level because there were some sellers here before, there were sellers here again, and the third time up there's less people willing to sell, and the traders that are selling are getting nervous because the price isn't going down like they had intended, and they all have to rush in and they panic, and it causes a nice trending move up. This is a very explosive 60, 65 pip move up. Or if you bought down here at 30, it went up 70 pips. This is a very common pattern. Price is kind of going sideways here at the hourly. If you had sold, it doesn't really look like it broke through the low here until about right here at 80. You always have your fib target from the highest high to the last swing. Look where the market went, right to the 1.618. So if you weren't greedy and you got short here at 81, you would have got out here at 16 with a small profit. Notice how the first time a nice sized trend came back to the hourly, it found resistance. And notice on the way up here, it got less and less strong right here. As it's going sideways and you see the strength fall off, it's underneath the hourly. You go short right here with a small profit. Comes back up again with even less strength than it had before. Then you short it again at 83. And now you have your fib targets down here, along with where one of my overnight Fibonacci profit targets. This is where I anticipated the low of the day being, and that's pretty much where it stopped, right at 40. So that last trade here at 82, you made about 42 pips on. So the hourly moving average, not only is it a great filter, but it finds a lot of good trades, very high probability trades. And when the price is in the middle of the range like this, typically price goes to the outer containment bands. It doesn't typically go too far above there, so you have good room to run, which gives you a better potential of catching bigger wins, which can make up for a lot of the losing trades or small losses that you have.